Hi everyone, welcome to this live event. As usual, I will be reviewing the weekly calendar and the charts to see what we can expect from currencies these days. Firstly, we'll start by sharing the macroeconomic calendar. Okay, here we are. Give me a second till I put it neat. Uh, I would like to start saying that we have a couple of interesting developments overnight, right? The first one was the decision of the Bank of Australia to cut rates, right, by 25 basis points to 1.5%. Uh, it's a record low. The market has largely anticipated this move. The Aussie suffered a downward knee jerk with the announcement, but quickly recovered ground as the market seems to be all about dollar weakness these days, right? But still, it's another central bank getting further into the easing path. Additionally, Bank of Japan has announced, in fact, not the Bank of Japan, the Prime Minister of Japan, Shinzo Abe, has finally unveiled and confirmed the stimulus measures, the fiscal ones that total 28.1 trillion yen, sorry. Part of it will be government spending, the other will be fiscal investment loans. In fact, it's pretty much what the market anticipated, and little is going to be uh, about real spending, So the fact is that the market also knew that, and instead of depreciating, the Japanese yen gained further ground after the news, as in the case of the OC, the news were priced in. Anyway, I remember a couple of weeks ago talking about how the US data was going strong into the second quarter and the third, at the beginning of the third, and how the market was putting some faith on soon to come rate hike in the US. And all of a sudden, last Wednesday, we have the funk minutes, the Fed saying that yeah, the economy is growing. Yeah, we are doing okay. Yeah, we are going to do better. But at the bottom line, they did not hint any possible rate hike for this year, and the market took it against the greenback ever since then. Friday's poor GDP second quarter readings in the US, well below half expected. We were expecting a 2.6 and we get a 1.2. Add fuel to the fire, right? The greenback is farther lower. I still believe that there are no much reasons for an euro rally. I still believe that the euro is among the weakest currencies, and I believe that price action is reflected. So, anyway, and with the calendar ahead, the fact is that we had quite negative data ever since the Fed made its announcement. We have been having poor US data for at least a week already, so that's quite that's quite sad for the poor dollar. But still, here we are, and we will take opportunities on that. In like an hour from now, the US will release its personal spending and income data. You know that the Fed uses personal consumption expenditure, core personal consumption expenditures figures to calculate inflation uh, in the US rather than the flat inflation figure. That helps the Fed determine if inflation is rising or not. So we need strong numbers in here. We really need them to confirm further dollar gains. As for the rest of the day, the only piece of relevant data would be employment in New Zealand, but I don't believe it's going to move the market much. Okay, on Wednesday, the services PMIs and composite PMIs for Europe. Um, I still see the service sector going strongly. I do believe that we had quite positive manufacturing readings, right? Despite below previous months, the sector was still growing. It's still growing in July. So I do expect good numbers in here and therefore a bit of support for the euro. The ADP in the US will gather some attention given that it's released a couple of days before the non-farm payroll report, but still, I do believe that this market services and composite index, which is a mixture of the services and the manufacturing one released last Friday, will gather most of the attention rather than the ADP. On Thursday, we have the Bank of England, and everything will focus on that. And in this expected 25 basic points rate cut. Uh, Again, this is largely anticipated, so instead of weakening the pound, it could put it farther higher, right? We are going to talk about the levels in a few. Still, we don't know if Governor Carney is ready to extend the SS Purchase Facility program, or if it's going to announce any other kind of measures, or even, in fact, if we would prefer to wait and see before cutting rates. So I do believe that we are going to have a quite interesting morning on Thursday with Bank of England. I mean, it's how many members will go out for keep rates and change or cut and so on. If the bank decides to leave its economic policy and change, I would see the pound recovering some ground, but still, I do believe that selling at higher levels will be a more much interesting trade than attempting to buy and bet on a sharp recovery, right? And finally, on Friday, we have the US employment report. The fact is that after a terrible, horrible May figure, we have a strong number in June. Economy created 287 new jobs. And now we are expecting 175 uh, for July, right? Remember, it's data from the previous month. If it's early August, represents what happened in the previous month. So, to be honest, 175 seems a nice number, and if the unemployment rate remains steady, it will be nice. But I do believe that the focus, if we have those numbers pretty much in line with expectations, will be in the average early earnings. As long as salary remain depressed, there's little employment can do for inflation, and if inflation does not rise, the Fed won't move rates either. Okay, the release is going to be alongside with Canadian monthly employment figures. Uh, they will have been coming pretty much in line with US ones. We're expecting a bit of a disappointment in here with the unemployment rate ticking higher. Uh, but overall, I do believe that I do believe I said this before. Non-farm payrolls had lost the power to impact the market as it has did a couple of years ago. I do believe that the market will focus more in other kind of data, in growth readings, and if we don't have any strongly upward surprise in the year, the dollar will remain in trouble. Okay. Anyway, I would focus my attention mostly in the Bank of England and in this week rather than in payrolls. Anyway, here we have charts. I do believe you received them. Yes, you do. Sorry, I was checking. And I was watching the euro that is flirting with the 112 level. It having been a few pips above it, but unable to break higher. Still looking bullish, but not actually that much, right? We are a few pips above the post Brexit high, which was 1189. We have this one at 1186, and still the pair is unable to rally. Modestly bullish, yes, but as I was saying earlier, there's not much of a self strength in euro to rally, right? There's nothing supporting strong gains in Europe. I believe that mostly because Draghi did not make a clear stance on what he thinks of the euro area after Brexit. Uh, he also entered in wait and see mode, and the market does not like that. The market wants to know what's going to happen, and there's a lot of uncertainty surrounding Europe also after Brexit, and we don't know when it's going to be triggered, if it's going to be triggered. I guess if it is because politicians said so, but still looks so dirty the future in there. Anyway, I put in the daily chart on because I have this trend line coming from 1615, which is uh, last May high, right? And today is coming around 1280 and 1270 for tomorrow. This week will be in between 1280 and 1260, and so I believe that that's a probable bullish target in the case we overcome 35, the 30-35 region, which is the immediate resistance, right? It's somehow, not today, of course, but if somehow the dollar keeps weakening and we have real poor payrolls, the pair could settle above this number by the end of the week. And therefore, I will be waiting for a rally up to 1460 for the upcoming days, which is a major static resistance area for a couple of years ago. We have been stalling around it. Take a look at your weekly chart, you will know what I'm talking about. 1460 around here, right? We have been trapped below the level with a couple of spikes above it, non-sustainable ones ever since early 2015, over a year and a half, right? So that's a probable bullish target in the case the pair breaks above the trend line. But gains beyond that level, oh my, simply so unlikely. Anyway, in the short term, the pair has been finding some intraday buying interest around 1150, right? We have that low from last Friday's American session. Yesterday also bottoming around there. So if somehow the price plummets below the level and accelerates, and I don't mean a couple of pips below 50, right? A real downward momentum in price, we can go down to 111, 111.20 today. And below that level, I do believe that the 1050 region where the pair has been stuck for most of the last 3 weeks is the next bearish target, right? It's some sort of a comfort zone where the price has been consolidating for much of the time after Brexit. I'm actually not seeing how the dollar can get that much ground, okay? And when it comes from the pound, if I take a look at my 4-hour charts, I want to cry really because nothing is going on in here, right? The 23.6% retracement of a post-Brexit slump continues to cap the upside around 33.20. I'm really hoping we see some action with the Bank of England. The fact is that the pound has been moving in a nice, interesting intraday range daily basis, but quite limited ever since the Brexit and with not much directional strength, so no trend in the year. I got there to say that if the Bank of England offers quite a large easing program, we can go down to 130, but I'm still not clear how the pair can break below 130 and hold below it unless more negative data keeps hitting the UK. And I would say that if we regain that 33.20, somehow the pair can go back to this highs, 35.20. Take a look. We have been standing around 35, 35.20 a couple of times ever since Brexit. This is the highest. So I would expect large selling interest around this area. And if somehow the pair breaks higher, that's the level I will be looking for a sell, right? I don't see it much higher these days. What seems much more interesting for me is the Australian dollar's behavior, right? I put back to the daily chart because we have this is the year bullish run, right? The yearly year we have corrected, held around the 61, and began again to rise. We have an initial movement, found support in the 50%, retracement of that rally, a second upward leg, and now finding support in the 38.2, and now heading back higher. Take a look at what the price did today. We have the Reserve Bank of Australia cutting rates, the pair plummeting, and even so now rallying towards 76, right? So overall, I'm sticking to my bullish stance in the Aussie. I doubted about it a couple of weeks ago, but I won't doubt anymore. I do believe that this pair is bullish, and we can go back towards the 78, 20, 30 region this year's highs. Okay. Now, for the shorter term, the 76 region has been quite a resistance. We have stalled this week around 76.10, 12. So let's take a look at the proof forward charts. We have plenty of highs and lows around that 76.10. So that's where the rally is heading to now. And I do believe that some follow through above the level can take us back to this high 76.70. Okay, it will take a break above this level to confirm a retest of the high at 78.20. If you think about it, in a world with negative interest rates and well, 1.5% is still way too much. So the rate differential keeps benefiting the OC these days. Furthermore, I do believe that the risk environment is helping also the OC, the gold to rally, and that is giving further support to the Australian dollar. Okay, when it comes to dollar Japanese yen, the fact is that market was too happy pricing in some sort of action, and that's where this really came from. And sort of action from, I mean, the Bank of Japan or A. But I do believe that the market was overreacting to with its expectations, pricing it way too much than what the market could offer. And we have the first disappointment last week when the Bank of Japan kept its interest rate steady and below negative, sorry, minus zero point 0.1. Indeed, they announced some uh, further loans in dollars and expanded their buying of bonds from 2.8 to 6 trillions or so, but still was not really what the market was expecting. It was way below market expectations. And we have this initial slide adding to what we commented earlier about the fiscal stimulus program announced today by AIB, which also fell short of market expectations, putting the pair back down. As of price behavior, take a look. We broke below the 61.8 of that rally. We pulled back, right? And then the price resumed its slide and it's a fresh low, all of which is indicating that the risk remains so on the downside and that the price will probably continue sliding, right? Particularly if we have negative dollar data. The low has been set around 100, 140 today. So I do believe that below this level, we can go first down to 101. The Japanese yen loves round numbers, but below that level, the light slide can stand down to 100.5 en route to 100. I don't know how sustainable could be a decline below the 100 level, and I do believe that that's sort of a line in the sand for the pair. I won't risk selling beyond that level. I do believe not today, not in a month. I would fear some non-announced intervention from the Bank of Japan beyond sorry the usual job owning. So that's for me a limit these days, right? A probable bearish target, and the most I can see it falling. Anyway, that Fibonacci retracement I mentioned is around 102.85. So if the price recovers above this level, at least, I'm not talking about a bullish recovery, but at least the bearish pressure will ease, above this level, the pair can recover up to 120, which is for me the next resistance, followed by this region, not the 50%, around 104, which the chart shows plenty of highs and lows lately, okay? The other thing that's quite interesting these days is oil prices, I have been following the price. It's holding about 40, but barely. Right? It looks quite bearish, although this latest 2 week steady slide suggests that it may correct higher. Nevertheless, what happened here is that with lower prices, the market producers, began to drill more. We had a quick rise in production, and so the overall glut fears came back much faster than we were initially expecting, or the market was initially expecting. Right? We have increase in stockpiles in the US, more drilling rigs. We have increase in stockpiles in derivatives also. So everything's looking gloomy for the poor crude oil. Still, I do believe that we may have a correction in here, so don't rush to bet on the downside. So I was looking for this region, the 38.80, 38.50 price zone. I do believe that if we break below that level, it will be a speculative interest, which will be driving the price even lower, and we could go back down to 35. I still don't believe we're going to go back to 25, but now 35 seems more likely. On the other hand, 42, 50, 43 seems to be a quite strong resistance area, and unless we sharply recover above that level, which I don't see how we could, the risk will remain towards the downside, right? So movements up to that level should be corrective and probably attract selling interests. And for gold, take a look. It has been rising steadily for 6 weeks, speculating that the Fed would act. Then there was some raft of positive US data that forced this downward corrective movement. At any rate, stand around the 38.2% retracement, and here we are going back after the Fed, in fact, failed to hint a rate hike. Yeah, I know. Over these last days, I do believe that it was Dudley, and today was Williams. I'm not sure, to be honest, who was today, but there was a couple of Fed members saying that, yeah, it's we're still in the tightening path. Yeah, a rate hike this year is possible, but honestly, the market is not convinced anymore with their talking. Right? They have been talking, talking, talking for 2 years already, and we just got one rate hike in the way. So the market is a bit of disappointed with their job morning, and unless we see a real action, I don't believe that the Fed will act or the market will believe in the Fed anymore. So that's overall supporting gold prices. I was thinking we have the next live meeting, in September, right, for the Fed, and we were too close to elections, so don't expect too much for September. Okay. Anyway, I have a double top in my spot gold charts around 1375.11. So I believe that we will probably be heading towards that level, particularly if the greenback remains under pressure and the yen keeps running and stocks keep plummeting. Take a look at stocks. They are doing pretty bad today. Anyway, and for the short term, we are getting closer to this 1362-63 region, which is for me the immediate static resistance. So I would say that a break above that level could take us towards the high of the year. Yeah, sorry. Above that level, 14 seems probable and possible. 1400, I mean. But it's that's the much I can see it as. I can see the dollar depreciation falling down to 100. I can see this running up to 1400. I'm not expecting any time soon, nothing beyond maybe 1500. Not talking about the almost $2,000 a troy ounce we saw a couple of years ago. Anyway, and for the short term again, the immediate support will be 1352, and 1345 will be the next one around there. Okay, but honestly, I won't be considering a sell unless we break below the 1333, 1335 region as quite strong static support area, right? I believe that pullbacks towards this level will likely be seen as buying opportunities rather than a signal of upward exhaustion. Okay? Okay. Sorry, I know I share my favorite pairs, and I know I don't talk too much about the Canadian dollar, but to be honest, Canadian dollars behavior is quite linked to gold, oil, sorry, and the Swiss franc. Well, we had a lot of intervention lately, and what happened is that at the first sign of dollar weakness, all of that hard efforts from the Switzerland national banks were plummeted away with the pair plummeting. So honestly, I'm not my favorite pairs to trade. Not that I rely on them. Anyway, share with you my thoughts today. So hope it helps. Hope you make some pips in the week, and see you, I believe, on Thursday with the Bank of England. Okay, thank you. Bye bye. See you soon.